Part 2 video on financial instruments, which is a continuation of financial literacy on investments, financial instruments, and risk management. So part 2 is about financial instruments, but first you need to answer the following questions or able to answer the following questions as a student. What are the financial instruments? The types of financial instruments that are available or that are there, their characteristics and their importance. What are financial instruments? They are tradable assets or securities that has monetary value. They are used to raise capital, manage risk, or invest. The main categories on financial instruments include, let's go to the categories of financial instruments. There are several types or categories. Includes debt instruments. This includes bonds. Bonds can either be government bonds or corporate bonds, and many others. We also have loans. Loans include bank loans or mortgages, and many others. We have money market instruments. These include treasury bills or commercial paper. We have equity instruments. This involves stocks, which can either be common or preferred shares. These stocks are generally shares of a company. We have equity-linked instruments, which includes warrants or convertible bonds. We have derivative instruments. These include options, which can be call options or put options. We have futures and forwards. We also have swaps, which involves interest rates, currency or currency default. We have several characteristics of financial instruments. They include liquidity. This is the ease and the speed at which the instrument can be converted to cash without any significant loss in value. In other words, liquidity means the investment can be easily converted into cash. That's the meaning of liquidity. So high liquid instruments include cash, government securities, and blue chip stocks. We have at number 2, the characteristic is risk return profile. These investments have risks and returns. We said our primary objective of investment is to get in returns. So let's continue. The trade-off between the potential risk and the risk associated with an instrument. This is how the risk and return associated with, for example, a stock. Generally, instruments with higher risk offer higher returns and vice versa. We always say the higher the risk, the higher the returns, or vice versa, the lower the risk, the lower the returns. So investing in a higher risky investment will produce high returns than those of low risk. Examples of these include treasury bonds. They have low risk and return, while stocks have a higher risk and return. So the most risk and return profile that involves higher returns involves stocks. Stocks have high risk but have high return potential. We have at number 3, maturity. Maturity is the length of time until the instrument has matured or must be repaid. There are 2 types of maturity. We have short-term instruments. This involves T-bills, this short term involves maturities of less than a year. Short term are always less than a year. Long term, we have 30 years or more than 1 year. 10 years can be 5 years. Those are long term. They involve like treasury bonds. They have maturities of more than 10 years. In other words, short term are less than 1 year and long term are more than 1 year. We have coupon or dividend. The interest payment on or dividend paid to the holder of a fixed income or equity instruments. This is the payment to the shareholder. The shareholder earns dividends. Coupon payments are made periodically for bonds. Most of the time, dividends involves bonds, while dividends are paid at the discretion of the company stocks. That was a mistake. Sorry. In other words, this coupon or dividend, they are paid at the discretion of the company stocks. When you sell your stock or you buy a stock, you get a dividend. We have financial instruments. The next we have financial importance of financial instruments. This includes raising capital for businesses, governments, and other entities. By using these instruments, you are able to raise your capital for the businesses or the governments or any other entity. It also provides investment opportunities for individuals and institutions. For example, you as a student will be able to invest in many opportunities. We also have enabling the transfer and management of financial risks. Having many financial instruments can help the investor be able to transfer or manage risks financially. We also have facilitating domestic and international trade and commerce. These instruments, they help in facilitating domestic activities and such as trade. It helps us at times expand our investment market. So thank you. That was a short one, but we have a part 3 coming up about risk management. Thank you for your time.